It is outlook season on Wall Street. You're familiar with that now. It's crystal ball type stuff. It's time to look into the crystal ball of Stifel. Barry Bannister expecting limited upside for stocks writing this. We see the S&P 500 topping out at roughly 4650 midway through next year as mega cap growth loses some ground to cyclical value as a result of economic growth, inflation and Federal Reserve tightness, all proving resilient. Barry, I'm pleased to say, joins us now for more. Barry, always great to touch base with you, sir. Great to catch up this morning. Thanks for being with us. Barry, let's talk about the recent rally first. What have you made of the last 4-5 weeks in this stock market?
Well, on Halloween, October 31st, we wrote a note saying the S&P would go to 44 and obviously overshot that, but we were positive going into year end. But what we're seeing in the market in the next 6 months is more of a rearranging of the deck chairs. As the economy, the growth proves persistent, the inflation proves sticky, we're actually saying that the cyclical value, the banks, cap goods, energy, financials, materials, transports, real estate, they would gain ground, and some of these mega cap tech would lose some ground on the price earnings multiple. And as a consequence, the market doesn't have a lot of upside.
Would you expect the bond market to reprice on that better data as well? And just to build on what you said about sectors, which sectors would tolerate that best?
That's just it. More of a positive economic growth, perhaps a higher PMI manufacturing. We're looking for 53 on that index. Pickup in industrial production, durable goods. Generally a strong economy. You know, it's not particularly robust in historical terms, but it's better than what was expected, not just here, but abroad, China and Europe. I go for the more deeper cyclicals. The cyclical growth names like the Apples and Nvidias of the world are pretty pricey. And I think what you do is see a rotation in the market. Not good for the cap-weighted index, but pretty good for investors who pick the right industries and stocks.
Barry, I wonder where that would leave the banks, which seem to be rallying on lower yields as much as they sold off on high yields, which is like an upside-down world. Not the world we're told about, not the world you and I have been used to over the years. Barry, where would that leave bank stocks?
Well, some of the horror stories with real estate are probably overdone in terms of the bank portfolios. The banks are also extremely well reserved. They're practically regulated utilities now. And I would argue that there's an oversold condition in the banks as the economy holds on because of a foreseen view that the loan loss reserves will not have to go up. There may even be releases back into earnings. So I think the banks would benefit from this. Again, we're talking about a trade, a rotational trade in the market within the context of a market that doesn't really go up much.
Banks had a decent week last week off the back of that bond market move. Barry, let's wrap things up by looking back before we start looking forward. When you start to say things like the growth can remain resilient, inflation can remain sticky, and that means tech maybe struggles, equal weight S&P over market cap weighted S&P, I think that makes a lot of sense to people, just as scenario analysis. But Barry, when you look back on the year, where growth has been pretty decent, yields have been higher, and yet tech stocks have managed to tolerate all of that and a whole lot more. Barry, what's your understanding of what's happened in the last 12 months, which makes you think it might be different in the next 12?
Well, the one thing that we probably could have caught and understood better was that after a 10-year period of prosperity for the technology sector as a whole, remember Meta's year of efficiency, well, what were they doing the prior 10 years? So what those companies did was cut costs. They had built up a lot of fat, and just like a person, they were able to lose that 10 pounds and keep those margins up. That had a lot to do with the earnings resilience of tech. And then, of course, the recent view that the Fed has done has helped the price earnings multiples. But I wouldn't get carried away with that. This Fed is concerned. This Fed has higher inflation right now than it's comfortable with. And they're in no hurry to cut, despite what the bond market's perception was. Do
you think we've seen the end of that cost-cutting exercise in Silicon Valley? Spotify this morning, 17% of the staff is going, stocks up 11%. To your point, the discipline that came through from Meta, that stock is up by 163% year to date, and some pretty decent top-line growth in there as well, Barry. Are you saying we've seen the end of that effort?
Earnings are great, but to be honest with you, the stock market itself aligns very closely with the growth rate, the 10-year growth rate, compound annual growth rate of the price earnings multiple. It's really a macro question of what's your multiple outlook. And one of the biggest changes in the market, the single biggest change, I would say, and of course the thing that most tightened the Goldman Sachs Financial Conditions Index in the last 2 years, was the Fed normalized the 10-year real yield, called the TIPS. That went from a minus 1.3 to a plus 2.3 at one point. And as a consequence, you had negative convexity. You had a price earnings multiple compression of the market. I don't see the Fed wanting the TIPS yield to go down dramatically. I think they've normalized it because inflation at some level is back. And so a more normal TIPS yield will keep a lid on price earnings multiple growth and thus keep a lid on S&P returns.